Behavioural Inflection Point. Welcome to the Foundation for the Study of Cycles, February 22nd, 2024, featuring what was recently shared with our exclusive Masters Working Group. Brief intro, Willian, your host and Global Cross-Asset Tactical Strategist, as well as FSC Development Director, a focus on both markets, cycles, but also behavioral finance, driven by high integrity education, a lot of which will be looking forward to rolling out later on this year on behalf of the FSC. Work that I also do with other groups such as IFTA, the International Federation of Technical Analysis, as part of that greater good education mission. Quick disclaimer in terms of the market insights that will be shared in this brief update on markets and on cycles. Behavioral inflection point and the three key sub-themes, all about the risk proxy turning that we are seeing across notably equities and bonds or yields for the last 3 months, post-Fed dovish pivot, which became official just recently, and I'll speak more about that in a moment. This idea of volatility based on the VIX being pretty calm during that time as we hit record highs in terms of equity market price and valuation, but also in terms of that rally that rocketed higher from November 2023 into the new year of 2024. Could this now be the calm before the storm, according to volatility VIX proxies? And then one potential wildcard trigger, which is certainly resurfacing in the collective minds of investors around the world, is geopolitical risk premium and what is termed crisis alpha. That'll be a special feature in our FSC Cycles blog. And if you want a deeper dive of the market outlook, watch a related media interview on the S&P 500 and various other investment opportunities themed is the market set for a fall. Brief word on my approach for those who are new to the framework. It's a macro blend, including behavioral technical analysis driven by cycles using quantitative and qualitative overlays. The cycles piece in yellow on the bottom right is driven by a roadmap signature model developed by mentor Robin Griffiths. The business cycle and seasonal patterns, along with expanded timing overlays that I've been working on ever since. And then last but not least, trend ranking models. This is more of the quant filter, focusing on global cross assets, sectors, stocks, and just general multi-factors. For more information, look for the book publication mapping the markets, published by mentor Robin Griffiths. Now, the roadmap boom bust cycle, which I typically feature as part of the framework, is a behavioral fractal pattern of market price action, typically asymmetric, based on unequal relationship between greed and fear, similar to the edit wave fractal, but different pattern variation, which is primarily based on timing models. You can see there's an economic business cycle overlay at the top with the traffic-like stages, early, mid, late recession, and also use of statistical regression analysis as a useful tool to measure trend equilibrium and deviations from trend, most importantly, which can lead to reversal signals. Right here and now, we continue to be late stage. both the market cycle and the economic growth pattern has remained strong. Recession has been delayed, but not avoided. And so we're still within that transition period between W, X, and Y, which leads to risk off, fall, rally, and then rest of fall, literally as we speak now in the first half of the year. Now, a blended framework of cycles, macro, big picture, and micro, small, is featured here on the screen, based on the work of economist Joseph Schumpeter and my mentor just highlighted. It begins with the Kondratiev wave cycle that influences interest rates, social mood, and technological innovation. There's more info on that on our FSC YouTube channel and within our blog archive articles. The jugular cycle, which is based on the boom-bust business cycle, averaging about 10 years. And then a subdivision of that, which is often related to the presidential cycle, very important this year as we run into exactly that period, November into year end. And then finally, the baby cycle based on seasonalities, where the patterns of the changing seasons, the calendar months, impact cross-asset, particularly equities, which is well known in terms of the start of the year being a bellwether for the performance of the rest of the year, the whole sell in May, go away, negative seasonality pattern, which tends to have its extreme downside in the month of June and September, which then leads into the October crash season. And then, of course, the year-end rally that follows to kickstart that whole seasonality pattern all over again. These cycles primarily influence global sentiment, policy, and markets. And what is most important is that each cycle, although unique, can align and create a so-called tidal wave effect or crisis opportunity. I'll speak more about this in future sessions, but essentially, the Kondratiev wave continues to imply that rates will be higher for longer as part of a structural uptrend for years ahead. We have found a floor at the 4% level on US 10-year yields, but that will likely resurge higher in the second half of this year, hitting that 5% historical threshold one more time and potentially higher thereafter, based on a historical cycle, but also that line in the sand, which is held for some time and can break. I'll move on to the next and final piece to the framework, and that is more of a breakdown of the blended approach. It shows macro, fundamental, and technical all together as part of a checklist process, which typically moves sequentially, but of course it can skip a beat and move independently. But that continues to show, despite a robust growth in the US, potential slowdown risk ahead. As I just mentioned, recession delayed but not avoided. Growth value rotation still to be waited for, but the expectation is that that will follow at some point. We've had echo movements already, but they've been too short-term to hold. What is now happening is that market internals are now narrowing year to date in the months of January and February. Although the market's been making new highs, market internals have been doing the opposite. We've also had a divergence in the classic Dow signal, Dow Industrials versus transportation, which did call market tops in the past. And market internals in general, in terms of concentration risk, now also starting to unwind, looking toppish with those Magnificent Seven or FANG unwinding from extreme levels not seen last since 2000 TMT in terms of concentration risk. The recommendation now and at the end of the session will be to shift into a barbell strategy, risk asset selectivity, profit taking with downside protection in parallel with a build-up of robust defensive plays such as gold, cash, quality bonds, and non-correlated portfolio risk, Japan being a case in point. Now let's progress with the main theme, behavioral inflection point. A picture speaks 1,000 words, and a cartoon even more. This is a credit to Hedgeye, that is famous for their financial captures. According to my work, market sentiment hit a behavioral inflection point across risk proxies in the last 3 months, already pricing in the so-called Fed dovish pivot, which is now official. However, there are several growing indications that the market is overly optimistic on economic growth market valuations and still aggressively positioned for Fed cuts, while vulnerable to either a policy mistake and recession risk. The big view, which is already available with clients that I liaise with, but also in the press, expect a non-consensus year in 2024 for stocks and bonds. Look for the opposite trade in a mean reversion contrarian setup. On a separate note, I'm a fan of cartoons or meme symbolism that helps capture thematic and timely socioeconomic behavioral signals. This often helps us to think outside the box, inspiring a lateral mindset, ask thoughtful questions, and check our biases. Again, credit to Hedgeye, and have a think about what your favorite behavioral signal or method is. Now, the behavioral inflection point in action on the S&P 500 is clear right here and now as we hit the top side of a rising corrective channel from the November 2022 lows. That is on the top side around the 5,000 roundophobia level and change. We're currently already reversing from that as the market is pressured by momentum divergences, rotation fragility, and asymmetric cycle risk. All of this is post-official Fed dovish pivot. Now, on the timing side, there's a risk confluence based on a blend of different overlays. You can see here short-term natural cycles, which are used in combination with the FSC model. Short-term natural cycles here in red, starting in the early month of Feb when the market hit that top side resistance into roundophobia 5,000, developed further acute momentum divergences, and then all the other signals that I mentioned continue to unwind. This is a 3-stage pattern, a fall, rally to come, rest of fall to follow. Watch for late Feb, when we're recording now, into March, where we're likely to get a short-term tactical panic low of up to 10%, which is the bottom side of this rising channel on current pricing, which will likely lead to an upside reaction, a new high, or even back to the old one, followed by a negative sell in May sim seasonality underperformance. The base case, as just mentioned, is for that 10% correction with elevated volatility. We'll see how that pattern unveils, but it will continue to add downside pressure with further and more impactful volatility from November onwards, in line with the US elections going into the new year of 2025. So look for mean reversion, a little bit of a roller coaster price pattern where we will get some big swings, but it will be challenging to trade. Remember, there are three key headwind factors. One, momentum extremes hitting the roundophobia 5,000 level on S&P 500 and other major markets with other levels. Rotation fragility in terms of market internals, and there are many different ways of measuring that. And the last piece, which I'll follow with, is on the timing side. So momentum, rotation, and timing. Now, on the rotation side, fragility continues year to date for the month of Jan and Feb, although the markets were pushing higher at their extremes, the internals were weakening in the sense that there were less stocks driving markets up. Now, what makes this more important is that we're not just seeing it broad-based in terms of number of stocks holding above their 50-day tactical and 200-day long-term moving averages on the S&P 500 as an example. We're also seeing this on the FANG stocks or MAG 6 or 7, depending on how you measure it, with some of these stocks already unwinding, like Tesla, now showing signs of topping and unwinding from extremes. Keep in mind that NVIDIA in particular is now showing signs of an early short-term reversal post latest Q4 earnings results. The stock remains a poster child for the sixth innovation echo wave since the Industrial Revolution. Take a look at that work on innovation cycles on our FSC YouTube channel and blog for more insights. The key point here is that, however, as with all disruptive innovation, it will develop in phases and still be prone to sharp corrections akin to 2000 TMT, boom, bubble, and bust cycle. And so here and now, we also see the FSC model signaling asymmetric risk on NVIDIA. It doesn't have to be a big decline, could just be a wobble or a correction. Either way, with the market cap weight being so strong vis-a-vis the major indices, that would create an unwind to the tune of 10% on the S&P 500 and maybe much more on individual stocks. Looking at the FSC model on the benchmark index, S&P 500, you can see that using a composite filter, it signals that three-stage pattern of a fall, rally, rest of fall. The risk increases from here and now, late Feb into March, where we're likely to get that short-term tactical panic low, followed by a upside reaction, and then a negative sell in May seasonality pattern. Most importantly, to avoid false signals, watch for a reversal below the 2023 July peak, just highlighted on this chart. The blue line is price. The yellow is the actual FSC cycle model. Notice right now we still have that negative divergences, price up, time down, but that is starting to realign. And if it does, here's your fall, rally, and rest of fall. Just as a quick disclaimer point, the FSC cycle model does not predict price magnitude, only time rhythm. So just for the purposes of the visual, that is not giving you a price projection. It's merely giving you the rhythm, expected rhythm of the market move. Okay, now if we just follow on to volatility on the VIX and this idea of a calm before the storm. So the VIX index had a minor spike just recently, and then it went back to sideways price action based on its relationship with the S&P 500. But if you look deep into the data, it's been trading below 20 points for more than 100 days, the longest run in 5 years. What you're looking here on this chart is a momentum measure of volatility. Now, relative historical analogs include COVID-19 shock of 2020 and the Volmageddon of 2018. Here and now, there's a big risk ahead. What could it be? The options are inflation, recession, US elections, or geopolitics. Time will tell. But what's interesting is, according to various sentiment indicators and also increasing headline news, there is a change in sentiment. One of my base case risk scenarios for 2024 is to be alert to broadening geopolitical risk and what is termed crisis alpha, as last year's obsession with inflation and central bank policy subsides. Now, indeed, we're seeing this change in sentiment across Wall Street, and as I just alluded to, related sentiment proxies, most notably a client survey by Goldman Sachs. Look at the chart, showing 54% of respondents picked geopolitics as their top risk, with US elections in second place at 17%, followed by inflation and recession at 15 to 14% respectively. The survey demonstrates investors are increasingly concerned about how to position should the conflict in Europe and the Middle East spread with rising China-Taiwan tensions. Also keep in mind that we have a record number of political elections which are close to call and will lead to further probable disruptive outcomes. So this is a special geopolitical year for many reasons. So on that point of geopolitical risk and crisis alpha, it's important to keep in mind that looking ahead, it's worth recalling that crisis alpha often drives equity volatility and broad risk off moves. This is a chart developed by Goldman Sachs, where they're measuring geopolitical risk in light blue, and they're overlaying it with volatility based on the VIX. Now, the key lesson here is that prolonged geopolitical risk uncertainty with broad impact is ultimately what will lead to a systemic reaction to markets. This includes events in the last 2 decades, such as, early on at least, the Russia-Ukraine War 2022, Crimea annexation 2014, Lebanon 2006, Iraq War 2003, and more historically, the Yom Kippur War 1973, and just before, the Cuban Missile Crisis. Now, they're all different in their own ways, but notice the spike in both geopolitical risk and equity market volatility. Here and now, alternative market impact proxies are also critical, notably shipping in the Red Sea, through which 12% of global trade passes, accounting for $1 trillion worth of goods annually. The Suez Canal traffic has already cliff dropped by 50%. Big question, will the Persian Gulf be next? An average of 21% of global oil and 26% of natural gas flows through here every year. Incidentally, there is a big and rare natural gas bullish cycle signal based on our FSC model that has been holding for some time. Of course, we do need to wait for confirmation, but this could be one of several potential macro upside risks. Look at the FSC YouTube channel hosted by Lars von Thienen, our FSC board member, that did a special video on natural gas and its upside signal. And just to complete, keep in mind the rolling waves of 1970s inflation and how this rhyme is likely taking place once again. The geopolitical risk premium is a flip the script wildcard to the disinflation narrative that could spark the next larger rolling wave of inflation volatility akin to the 1970s. Interestingly, this also seems in line with the view of a selection of industry peers expecting either a geopolitical recession or a market crash in 2024/2025 to force central banks to act. FSC Masters Working Group can review content in our online forum. Take heed of the latest expanded Gaza-Rafah offensive, which may now reportedly lead to the suspension of peace treaty between Egypt, Israel, and ultimately further overspill to the region. Timing and market impact tends to be a hard thing to anticipate, although remain vigilant of our tactical risk windows just highlighted between late Feb into March and thereafter H2 from October, November into 2025. The long-term inflation resurgence acceleration is likely in the second half of this year going into 2026. And I'll just highlight a few on the chart. So the lows that we're seeing in inflation in that last mile are taking place after inflation halved from the last year or so. But there is likely a resurgence ahead. And that happens to be in line with the 18.6-year cycle timing on risk markets that, again, you would have seen featured with FSC past material. What do we do in terms of the bottom line to investing, trading, and portfolios? The recommendation is allocations to commodities, especially oil and gold, both exhibiting spike risks, and Swiss franc among currencies are historically reliable diversifiers. Of course, FSC members can evaluate their own positioning according to their own views. This is just for educational purposes based on my own view and analysis. Read more in the blog for further details. Hope you found it insightful. We've looked at behavioral inflection point across risk proxies, volatility based on the VIX, calm before the storm, geopolitical risk premium and crisis alpha. Watch out for the related media interview, Cycle's blog. Thank you very much. Ron William, FSC Development Director. All the best.